If the system is failing, why does it keep surviving? Every crisis exposes its flaws. Every election promises repair, and yet the structure remains. You wake up inside rules you did not choose. Currencies decide your value before you speak. Borders decide where you may stand. Debt decides how long you must work. Most people believe power lives in faces: presidents, CEOs, generals. But faces change, the system does not. Look at a world map. Trade routes glow like veins. Financial centers pulse like organs. The pattern is older than any nation still alive. This is not an accident. It is not chaos. It is design refined over centuries. In 1694, England was nearly bankrupt. War had drained the crown. Taxes failed. So Parliament authorized a private institution to lend money to the state. In return, it received interest, influence, and permanence. The Bank of England was born. A government now owed its future to a system that never slept. Debt replaced conquest. Ledgers replaced swords. This idea traveled across empires, across oceans. By the 1800s, nations no longer rose by gold alone. They rose by credit. On screen, parchment contracts fade into railways. Railways fade into factories, built on schedules and wages. The genius was subtle. You no longer needed to be forced. Participation became survival. Once a system controls how food, shelter, and security are accessed, resistance becomes theoretical. You can protest, you can vote, but you must still pay. The system did not promise justice, it promised continuity, and continuity, once achieved, becomes the highest form of power. In the 19th century, the system learned to scale. Steam compressed distance, telegraphs compressed time. Markets that once slept now watched the sun move across the globe. On screen, a clock spins over a map. London hands off to New York hands off to Tokyo. Money never rests. This was not convenience, it was control through continuity. Industrial capital required predictability. Factories could not wait for seasons. Investors could not wait for kings. So systems were built to remove pauses. The gold standard did this quietly. Currencies chained to metal, metal chained to vaults, vaults chained to institutions few ever saw. When governments wanted to spend more than they had, they borrowed. When borrowing grew dangerous, they standardized. Rules replaced discretion. Spreadsheets replaced debate. By 1870, global trade volumes exploded. Empires spoke different languages, but their balance sheets rhymed. If one failed, others felt it. Crises became contagious, but contagion taught a lesson. Interdependence discourages defiance. The message was simple. If you leave the system, you fall alone. If you stay, you fall together. People accepted this because it felt modern. Progress had a sound: steam, steel, whistles at dawn. Work became identity. Time became money. Money became obligation. You were no longer ruled by a crown. You were ruled by schedules and numbers that never argued back. The system did not ask for loyalty, it made itself necessary. And once necessity is established, choice quietly disappears. The 20th century arrived with a promise of liberation. Democracy expanded, empires cracked, new flags rose over old capitals. On screen, crowds celebrate, ballots drop into boxes, radio waves carry speeches about freedom. But beneath the surface, the machinery stayed intact. Wars were no longer paid for with treasure, they were financed, bonds sold to citizens, interest promised to the future. In 1913, the United States created the Federal Reserve, not a government agency in the way people imagine, a hybrid, public purpose, private structure. Its mandate was stability, its tool was money creation, invisible, adjustable, distant. When World War I ended, the deaths remained. When the Great Depression struck, the lesson hardened. Never let the system collapse. The cost is too high. On screen, bread lines dissolve into assembly lines. New Deal programs map the state onto daily life. People felt saved, and in many ways they were. But rescue came with architecture. Social safety nets tied citizens closer to central authority. Stability required scale. Scale required permanence. In 1944, as bombs still fell, delegates met in Bretton Woods. They redrew the financial map of the world. The dollar became the axis. Institutions were born to manage compliance. The IMF, the World Bank. Nations could now fail safely, but only if they followed instructions. Loans came with conditions: austerity, privatization, structural adjustment. On screen, a developing nation's budget shrinks as payments flow outward. This was not cruelty, it was consistency. The system was learning to survive collapse, and every safeguard made escape more remote. The illusion of permanence deepened after 1971. That year, the United States quietly severed the dollar from gold. No announcement to the public, no referendum, just a weekend decision. On screen, a television flickers. Nixon speaks. Markets blink. The anchor drifts. Money was no longer a claim on something real. It became a claim on trust, and trust could be expanded infinitely. This unlocked something dangerous. Governments could spend without restraint. Banks could lend without reserves. Growth no longer needed a ceiling. Debt stopped being a temporary bridge. It became the road itself. Charts fill the screen. Lines curve upward. Household debt, corporate debt, sovereign debt. People felt richer. Homes grew larger. Credit cards multiplied. The future was pulled forward into the present. But obligation followed. Every dollar created required repayment. If not today, then tomorrow. If not by you, then by those who come after. Psychologically, this was genius. The cost was invisible, the reward immediate. You could live beyond your means without seeing the chain, because the chain was time. By the 1990s, finance had detached from production. Money made money. Speed replaced labor. Trading floors roared. Screens stacked like walls. Decisions happened in milliseconds. Risk was dispersed, then forgotten, until it wasn't. The system had learned a final lesson. If everything is connected, failure becomes unacceptable. And when failure is unacceptable, permanence becomes policy. The crisis of 2008 was not an accident, it was a stress test. On screen, mortgage documents stack into towers, subprime loans, adjustable rates, promises sliced and sold. Banks did not invent complexity to hide risk. They invented it to move risk elsewhere, to pension funds, to municipalities, to anyone far enough away to matter later. When the housing market slowed, the system should have corrected. Prices should have fallen. Institutions should have failed. Instead, governments intervened. Trillions appeared overnight. Central banks expanded their balance sheets like lungs under pressure. People asked who was being rescued. The answer was structural. If major banks collapsed, payments would stop. ATMs would go dark. Payrolls would freeze. The system would seize. So it was saved. Executives kept bonuses, shareholders recovered, losses were socialized, gains remained private. This taught a lesson more powerful than any law: size equals immunity. From that moment, markets understood the rules: take risk, grow large, become indispensable. Regulation followed, but carefully, not to dismantle, to stabilize. On screen, compliance manuals thicken. Risk models multiply. Nothing fundamental changes. Public anger flared, then faded, because outrage requires alternatives, and none were offered. The system framed collapse as apocalypse, reform as danger, continuity as responsibility. People accepted this because fear works: fear of losing savings, fear of unemployment, fear of disorder. Stability became morality, questioning became reckless, and a system that can define fear can define reality. By the 2010s, the system had perfected invisibility. Algorithms now monitored transactions globally, high-frequency trades executed faster than any human could track. Credit scoring, insurance risk, employment eligibility, all automated. On screen, data streams flow like rivers of light. Cities pulse with invisible calculations. Borders remain, but money and attention are tracked everywhere. Participation became compulsory, not because of force, but because of structure. You cannot earn a wage without banking. You cannot spend without currency. You cannot move without identification. Even dissent is absorbed. Cryptocurrencies promise escape, but rely on electricity and networks you cannot own. Alternative economies exist, yet they are contained, observed, quantified. Psychologically, this produces compliance, not fear alone, not loyalty, acceptance. You obey the system because life outside it is incomprehensible. The edges feel empty. Collapse feels like a void. The system became not a ruler, but a terrain. You cannot conquer it, you can only navigate it, and navigation requires submission. Power now lives in permanence, not in personalities. CEOs rotate, presidents retire, bankers vanish, but the architecture endures. Rules outlive individuals, debt outlives generations, institutions become larger than the people who created them. On screen, skyscrapers of glass, central banks with marble floors, server farms humming under concrete. Maps display interlocking networks of trade, investment, and logistics. Lines connect continents. Lines connect lives. The genius of the system is subtle. It rewards compliance and punishes isolation. Growth is mandatory. Interdependence is invisible. Dependency feels natural. Even reform reinforces it. Raise taxes on corporations, they shift offshore. Increase social spending, borrowing grows. Introduce new regulations, complexity rises. Every adjustment is absorbed. Every crisis is leveraged. Every protest becomes an input. Every innovation becomes a tool. People accept this because the cost of withdrawal is infinite. You cannot opt out. You cannot pause. You can only continue. And over decades, generations internalize it. The system is no longer external. It is instinct. The machinery does not coerce. It seduces through necessity. The system's endurance relies on paradox. It is fragile enough to terrify, yet strong enough to survive everything. On screen, stock market plunges, banks rescued, currencies wobble, yet recovery unfolds. Charts spike, crash, and spike again. Debt rises with each cycle. Dependence deepens. Every failure is a lesson. Every rescue a blueprint. Every bailout a reinforcement. Look at Greece in 2010. Sovereign debt soared about 120% of GDP. Unemployment spiked. Austerity programs shredded lives. Yet the European Union and IMF imposed conditions, ensuring repayment, restructuring, and control. The population revolted, and yet the system persisted. Debt dictated the terms of sovereignty. Borders remained, governments bowed, and obligations were met. Or take Japan after 1990. Asset bubble burst, banks teetered, deflation persisted for decades, but policies, interventions, and stimulus kept the machinery humming. Crisis is not a flaw, it is a feature. The system does not break, it flexes, it adapts, it survives, and every survival makes escape more improbable. By the 2020s, the system had grown beyond comprehension. Trillions circulate daily. Markets operate across time zones in microseconds. Derivatives multiply faster than human cognition. Governments, corporations, and algorithms are all entangled. On screen, LED tickers wrapping skyscrapers, digital flows of money stretching across continents, servers humming in dark rooms. Every action you take is captured. every transaction mapped, every loan, lease, and subscription tied to identity. Escape is theoretically possible, but practically inconceivable. Even alternative currencies, decentralized networks, or off-grid living require resources the system controls. Electricity, internet, access, law, everything is mediated through the architecture you cannot exit. Psychologically, the system trains compliance. You fear collapse more than oppression. You plan within its boundaries. You dream inside its box. Dependence feels like choice. Structure feels like security. Debt feels like life. The system is not coercion. It is inevitability. And once inevitability becomes instinct, the machinery no longer needs guards. It runs itself, and you run inside it. Every rule, every obligation, every contract, every debt, they were never mistakes, they were deliberate. On screen, ledgers stacking into towers, cities glowing from unseen networks, borders traced not with walls, but with credit lines, electric grids, and compliance systems. The architecture is permanent because it was designed to be. Every crisis reinforces it. Every rescue expands it. Every reform absorbs and adapts. Look back at history. Bank of England, 1694, Bretton Woods, 1944, the Federal Reserve, 1913, 2008, 2020. Each moment appears chaotic. Each moment seems like failure. But viewed from above, a pattern emerges. Debt is not a flaw. Dependency is not an accident. Continuity is the goal. Escape is impossible because the system does not merely exist. It defines reality. It shapes possibility. It conditions imagination. You live inside it. You breathe inside it. Even resistance flows through it, absorbed and measured. And the quiet truth is this: the system is not broken. It functions exactly as intended. The machinery does not need rulers. It needs permanence. It does not ask for obedience. It ensures inevitability. If you feel trapped, it is not because you have failed. It is because the system was never meant to let you leave. And when the lights dim, the ledgers close, and the markets sleep for a moment, the architecture remains. Unseen, immutable, infinite. And you are still inside it.